So we've got a trailing wind coming into the markets, coming out of China on the back of optimism around a trade deal. It is a heavy week for macro. ECB meeting, obviously, we'll focus on, and the MPC meeting in China, which we'll get to in just a moment. Why are we going up on markets?
Yeah, we are seeing quite an interesting change. No, on one side, we are seeing that markets are getting used to the idea that this is a slowdown, but not a massive recession or a global recession or a crisis. No, the second is obviously liquidity. Central banks have changed the tone. Chinese central bank, ECB, the Fed, everybody's changing the tone, and therefore liquidity has gone up quite dramatically all over the world, and that obviously feeds into markets. However, macro data continues to worsen and continues to be extremely weak, and I think that these headlines like the trade deal or the comments from the different central banks cannot disguise the fact that the slowdown is evident and due to other factors, not just the trade war. And therefore, I think it's a good time to, with being prudently optimistic, take the foot off the pedal of the super cyclicals. Take the foot off the pedals of the stocks or the asset classes that are more driven towards an improvement in inflation, an improvement in growth that is quite unlikely to happen.
The trouble is, if we get a Teltro announcement this week from the ECB, that will only increase the momentum here, won't it, in terms of liquidity? And as we know, liquidity really floats all boats.
Exactly.
You can forget about the fundamentals for a while if there's plenty of cash around.
Completely, but fundamentals do matter. So you need to be aware that the market was relatively cheap at the end of the year, but it's gone to relatively expensive yet again. So you need to be aware of valuations. You need to be aware that those multiples have been expanding while earnings guidance has not improved. So you have to be cautious from that perspective. And obviously, we're all here to enjoy a little bit of momentum. That is fantastic. But you have sectors that are up 12% on the year, that in which earnings growth is expected to be less than single digit, if not flat. So you have to at least acknowledge that factor and not just get sucked into the liquidity vacuum, because that also fires back. It can be a boomerang afterwards.
So Dan, help us out with the time frame, how we think about how the economy should play out. Just say we get a trade deal. Do we wait for, what, a quarter for growth for some of the numbers to improve on the manufacturing side, consumer confidence? How should the rest of the year play out if we do get this handshake on the 27th of March in Florida?
Well, I think that the agreement itself is very likely to be a zero-sum game, if you think about it, because for many emerging markets it's going to be less exports to China, because some of those soya, natural gas are going to come from the US now, and there is absolutely no evidence that China is importing less than what it needs. Actually, if there's any evidence, is of the contrary, because of the rise in inventories. In my opinion, what I think is that you need to be looking at what are the details of this trade deal. Is it going to really make a change? I fear that it's actually going to be very much about small details here and there, but it's not going to change things, and definitely not change the trend of global growth, because the reason why global growth is slowing down is not because of the trade war, it's because of debt saturation.
So we're in for a big fat disappointment, is what you're saying.
Not big fat disappointment. I think it's good for sentiment that you don't have two of the largest economies in a trade war. That is obviously a positive. And there is always going to be some sort of change in mentality from companies about deciding to make investment decisions, but it's not going to be the major driver of a change in trend. The trend of slowdown started way before the trade challenges started and the tariffs started. The Chinese slowdown has nothing to do with trade war.
Which then pushes us into a narrative talking about fiscal stimulus.
Yeah.
If growth is not going to be strong enough, we know governments in a highly political environment right now are not going to sit back and just weather a slowdown economically, which means they're going to loosen the purse strings, so to speak. Do you expect that to happen in the United States? as a starting point?
Well, the United States has been a fiscal stimulus for a decade. And the European Union has been a constant chain of stimuli all over since actually before the crisis. No,
but in terms of infrastructure spending, that's the big sort of ticket item, I guess, the market's now watching.
My concern about infrastructure spending is that obviously it's something that can do something about the economy, but it's not a driver. And more importantly, when governments start to talk dramatically about infrastructure spending, we need to think about white elephants. We need to think Japan. We need to think the European Union. The European Union has constantly sent these messages about massive infrastructure, green, etc., and look at the growth that it achieves. So just take it with a pinch of salt, because infrastructure spending mostly, obviously there is infrastructure spending that is needed, absolutely that is the case. However, most of these white elephants, what they make is the economy less dynamic, not more dynamic.
So the ECB, if we get an announcement this week on a fresh TLTRO program, and just to remind the audience, this is effectively about pushing money through the existing banking system, how stimulative will that be to either growth in the Eurozone or indeed just the opportunity for equities to start to participate in this global rally?
For the growth of the Eurozone, very little. TLTROs end up being basically a problem of diagnosis. ECB believes that the reason why credit growth is not as much as they had planned is because of lack of liquidity injections. It is not because of lack of liquidity. There's 1.8 trillion of excess liquidity at the ECB. It's because there is no need. There is overcapacity in the Eurozone, and obviously aging population, technology, all these things that we've been talking about so many times. So it is likely to do very little in terms of growth. However, it is likely to do quite a lot in terms of equities. For example, the challenges of the banking system that affected the equities of banks last year are likely to be sort of disguised by TLTROs, and you remember that it already happened when Trichet did that a few years ago. No, so we need to be aware of the placebo effect on equity markets, but it's very likely to do very little in terms of growth, because credit growth in the Eurozone, let's start from that premise, is not bad. It's already twice the GDP growth.
Can we talk about then how the ECB communicates to the market? Because often when you send a message that you're doing more in terms of stimulus, that has a potentially negative effect, because the market's been looking for an exit, waiting for that step towards the doorway, like we've seen in the United States and elsewhere. So how negative a message is it that there's more work to be done from the ECB, not less?
There's an underlying negative message in the idea that the economy obviously is not strong, and therefore the ECB not only continues to need to be accommodative, but it needs to be proactive. That, I think, is a big shift in message. It's not just, let's say, a path of normalization that sort of helps gradually get out of stimulus. It's that they're actually reversing 180 degrees their policy, and that actually means that they know something about the economy that is worse than what the citizen perceives.
Well, there is going to be a downgrade to growth, one imagines, at this meeting coming this week.
Sure.
Just as an acknowledgement of the reality of the justification for that change in the language back in January, that the downside risk has now come back into the narrative as far as the ECB is concerned. So what else could they do at this stage? If they're going to announce weaker glide path on growth, they have to have something to show the market, don't they?
They have to.
Or would you rather Draghi holds his nerve and just says growth may be moderating, but hey, we need to normalize?
I think that it would give a much better message by saying not normalizing is not what needs to be done. What they have to say is, look, what the monetary policy has done is to cement the existence of the euro, is to allow the countries to do a little bit more about growth. Now, what governments need to do is to let the economies breathe. With the threat of further deficits, with the threat of higher tax wedges, with the risk of government governments putting more brakes in the economy, that is definitely not going to happen. So it's not something about monetary policy. Draghi has said it a few times. It is about government and fiscal policy. I get the impression when I look at the numbers that it's either a company that is going to make between 2 to 3 capital increases, massive capital increases in order to finance working capital, or a company that is not going to deliver on growth. Where am I wrong?
Well, there's, I mean, definitely Tesla has been pitched as a very high growth story. I think we're going through a phase, and we saw that end of 18 and then 19, I think is important for that. The Tesla investment case works to some extent if you have smaller or slower growth, because you need to get into a phase of consolidation. And so 19 will be critical because they will grow more slowly, definitely. Hopefully they will grow profitably. They will, to some extent, de-stress that balance sheet a little bit, and from there they can grow again. That is the upside. But the debate about growth versus no growth at Tesla, I think right now what they need to, in our view, what they will demonstrate, hopefully or not, we'll see, is the ability to stabilize the cash generation, stabilize the balance sheet by growing more slowly, while still moving to that phase where they're not just a niche premium into a more volume. If they go through that phase reasonably successfully, I think there's a very strong case that Tesla can be self-funding.
And it also made sense in that, I mean, just because you're in a car doesn't mean that's your only mode of transport.
Absolutely.
You might actually hop in an Uber or a Lyft in the morning, you might drive your car in the evening, go on holidays, you might hire a Zipcar or some other car service as well. So they're trying to blend these different services together, which is a little bit like what happens in real life, would you believe?
Absolutely. But that is, at the end of the day, the challenge of the sector is that on one side, technology and disruptive technologies and the circular economy are clearly going to drive the sector to a completely different way of understanding how people drive their cars and how people go use about transportation. However, on the other side, they continue to have a model that is based on producing way too much in order for people to change their vehicle once every 3 to 4 years, and that is not going to happen.
Well, let me just ask a very simple question here. Two scenarios. One is that you are in a driverless vehicle that is taking you to your destination and it's being steered there by chips and a computer. The other is that you are being taken there by a person who is operating on the clock in a low budget company that is, and that person is incentivized to get you there as quickly as possible so they can move on to the next job because they are operating at near minimum wage. Which of those two alternatives would attract you?
Yeah, which is safer? Probably the self-driving option, based on that. Which
the
changes
self-driving option? No, I would rather say the second.
You go with the second?
I would go with the second.
Right.
having a real driver in the car.
Because if you think about it, the first one entails a disproportionate risk of, what is going to happen for your safety relative to the other, in which the incentive is both on your safety and on cost. I don't know. It's a very good question, actually. It's a very good question because it makes a very big difference to, to trust. You trust that somebody that's going to drive you somewhere knows better and knows how to do things in a better way. Not so much with a chip. It's not the same to use a PC than to sit on a car and let it drive you.
We're back in that dilemma about, if you're in a car and there is a risk that the vehicle would take more lives by proceeding on a given path rather than veering off in another direction where it only saves you. What does the chip do at that point?
Well, it keeps
does
on
it
learning,
veer away from the bus that it's heading towards and accepts that you have to die as a consequence of the greater good? Because that's where we're going with some of this chip technology.
Oh, This is boardroom discussion level in the auto industry, I think, about what sort of decisions are made.
I can imagine, but it is definitely one difficult selling point for driverless cars. Very difficult.
We are also going to be bringing you much more from the sector this week, live from the Geneva Motor Show all week. Annette will be covering.
Let's pick up with Dan Lacalle. A couple of stories just to tick the box with you. Does China need a new technology exchange in Shanghai, or a new board? I mean, effectively, you've got Chinext in Shenzhen. Hong Kong also positioned itself really for dual listing of Chinese technology companies. Do we need another board, or does this tell us something about China's desperate need for foreign capital?
I think that it tells us quite a lot about its need to attract capital. I think that it does not need it, but it's a smart move. I think that it's a smart move because if it puts in that index those companies that are on a startup phase, those that actually go up very, very significantly when they start succeeding and when their ideas are the brightest, then obviously it's going to attract a lot more capital than it is doing right now. I think it's a way of continuing to have capital controls as the country has, while at the same time trying to find ways to get foreign investors to put money into the tech space. It's a smart move. I don't know if it'll work, but it's definitely a smart move.
Do investors care about red ink? I mean, red ink. We've seen so many companies come to market that do not make a profit. Yeah. And now we have all the big items, all the names that everybody knows of in the space coming to market this year. Lyft, Uber, and potentially others down the track. Do investors care that they don't make money at this point?
Investors start to care. Start to care because there's a phase in which you start to get really nervous about something that goes from being a good idea to being a legitimate business. And as technology is evolving so rapidly and so many companies are coming to the market, delivering starts to be more and more important. And that is the reason actually why inflow of capital into startups is being much more selective, because before it looked like it was almost like a safe bet to put money on anything and not care about earnings. But now you need to really look at legitimate, valid businesses.
Frees up a lot of money, though, from private markets, doesn't it? A lot of money has been trapped in some of these big names for a long time. Absolutely. So it could be interesting for that private market. Anyway.
And valuations back to expensive from cheap. Where do you think he should put the money at this stage in order to continue to be invested? Because if you get completely out, then you never go back in. So,
well, I guess not what we don't do this. We're not involved in ETFs. We're not involved in index trading or investing. But I guess that would kind of be a way to go, right? Just park it, because I think the fact of the matter is at the moment that with the absence of alpha, there is no doubt about it. Beta is the only thing you can buy into. Yeah. Sentiment is positive. Cyclicals are driving markets currently. It suggests that people still are buying into growth rather than defensive. Defensives are still sort of lower beta, are continuing to underperform. And I suppose you've just got to be going on the view that I think the market is going higher. Yeah. And I've got to be in on that train. I think it's a very
nervous, though. We've got those very low levels of volatility, like what we had before that market meltdown last year. Feels like there's something strange, eerie going on in markets again.
Well, I don't know whether you can show this chart. It was one of the. You can. Yeah, Jeff is nodding. It's well, there's the VIX. Which, as you say, is low, down to that sort of the 13, 14 level, maybe even lower than that currently. And then you've got the way that we look at volatility, which is the volatility of share of prices around those value trends. And what we're seeing at the moment is those ranges blowing out. Now they're very wide, which means that where you were trading to where you are trading is now showing a sort of significant differential. Prices continue to go up, share prices continue to go up. So although the volatility of which those share prices can move currently is quite great, what it's showing you is that the strength of that move higher is very strong. So actually, although the range is wide, what it's saying is that actually there's a consistency there, a belief that prices are going to continue to go higher. So it's kind of an inverted way of looking at volatility.
Well, we got there eventually, so that's the chart that you wanted to show.
Almost 2020 by the time we got there.
We've got a few more, have we? The director, we've got a few more that we can roll through.
That's the VIX there versus that fair value range.
Yeah, can we have a look at the beta cyclicals? Let's roll them through. Since Rob went to the effort of giving us these charts, let's show him that we can actually make them. If you want to talk to them, Rob, that would be perfect television. Yeah,
so basically, this is what we look at is just momentum of sectors. We're looking at the top performing 4 sectors in terms of momentum in the SXXP versus the bottom 4. And that is just suggesting there that you see that at the beginning of the year you had the higher beta completely take over from lower beta. It got to an extreme. You saw a momentary reversal of that as confidence began to ebb away, and now you've seen higher beta sort of take over again. And what this means in terms of just what you were saying now is the fact that that is where you have to be. That is where price efficiency is very positive here at the moment, and that's where momentum is. And I think if you're in the market at the moment, if you're lucky enough to be there, you probably stay in there for a little longer.
Okay. You wanted to make a point?
Just one thing chart. I wanted to be about that chart, which I find fascinating, is how the highest beta sectors drive immediately the market higher, but if you stay in defensives, you're going to suffer the entire fall. It does not matter where you are. So I think that what the markets are doing right now is precisely looking at these super cyclicals and say, look, I'd rather be in those rather than defensives, because defensives are going to lose as much money as the high beta sectors once the VIX starts to move the other way around, no?
Yeah, I mean, that's exactly what it shows. What these charts show is those levels of extremes, and they're cautionary signs of a potential rotation. I think the problem that you've got here, I mean, we talked about it in our note of investors being strong-armed into the market. And with all the news that comes out versus China, particularly China, there's only one story out there. If you actually had somebody on the inside in Washington, you were sort of able to trade off his ideas, you'd be making a fortune right now. Because that's essentially what it is. It's just this bet that there is going to be a deal, a trade deal, and these cyclicals are rallying accordingly.
So the cyclicals are rallying on the prospect of a China deal. It's not because the underlying economic momentum is strong. Let's be clear here, because Daniel was suggesting earlier that we pile out of cyclicals and acknowledge the fact that some of the data points are actually just decelerating.
I think the problem you have here is the momentum. You can't fight. You can fight it, but with the work that we do, which is valuation and momentum and sentiment. At the moment, as I said, on a valuation point of view, it's difficult to justify buying into anything right now. But you can't get away from the fact that momentum and sentiment is very, very strong. So you're sort of hanging in there, waiting for that momentum to change. I think it's a trader's market at the moment. Perhaps not an investor's, not a longer-term investor's market.
Okay. You still have to acknowledge the slowdown.
Yeah, absolutely. I mean, the data's there. I mean, every economic indicator you see from everywhere tells you that there is a slowdown taking place. But as you mentioned, Jeff, over the last few years, central bank liquidity has been the driver. And if we've learned anything, that is not to be ignored.
We have looked at, for example, banks in Europe at the beginning of the year because of the likelihood of TLTROs, which is and the likelihood of delaying the provisions that they would need to take in a change of ECB strategy. We looked as well at some of the miners. We've taken the foot off the pedal, for example, from integrated energy, but we have increased exposure, for example, to services because capital expenditure is rising. And in terms of growth with reasonably priced, we think that in the United States you still find much better alternatives after the earnings. And from a technical perspective, if you look at the global equity markets, you have, on a relative strength basis, it looks like many markets are oversold or overbought, or close to overbought. On the other side, you have economic sentiment coming down, and on the other side, you have outflows out of equities and into bonds. So Where do you see that the combination of those three elements or other as being more attractive right now in technical terms? Obviously?
I mean, I think in terms of, you're right in terms of, you know, the overbought measures. You know, I think if you look at the S&P, the US, where 86% of S&P stocks are now above their medium-term average, and anything over 80 is typically getting overbought. You're also starting to sort of, you know, really hit sort of, you know, the extent of the moves that we've seen, sort of overbought measures on virtually every measure, but there is no putting the market back. I think what's striking is if you look at something like a macro data surprise index, that's been going vertically south.
Exactly.
And the market's just ignoring the data completely, and it's still ignoring the data. I think at the moment it suggests to me we are in this ballpark of where this market sort of does stall out, but it's clearly at the moment not yet, and it clearly continues. I think the US is still back on that outperformance story. It's still covered. I actually think Europe has put in a significant improvement in these last 3 or 4 weeks, starting with the periphery, Italy, but now also Spain, banks that we were talking about earlier as well. So actually, I think Europe has been everybody's one they've hated, and it's been that one that's come around the corner and gone, actually, no, we've actually outperformed in Europe for whatever reasons.
That instils change. It's not going to happen if it comes from the public sector. The public sector is actually always going to drive much more about keeping the status quo. If you look at what the circular economy is doing, technology disruption is doing, is actually empowering women in Central Africa, is empowering women in India, is empowering women to actually build their businesses because the requirements of capital are actually lower. So the good things about developing the circular economy, developing innovation, developing technology, is that gender equality comes with it, instead of trying to make it sort of a policy that ends up actually prolonging the status quo, no?
Is that enough, Shola, though?
No, heck no. We need both. We need everything on the table. This can no longer be a situation whereby women wait your turn, or let's do this first, or not. We know that we live in societies where the law, legislation plays a role. We also understand that in all of the examples you've given, how much representation do you have in terms of diversity so that it can truly drive change? I bet you anything, you don't have enough women, enough Black, Asian, minority ethnic groups. You need all of those voices. And people with disability are experiencing real inequality. Where's the representation of LGBTQI? All of that is really important for us to be able to drive change. So women, as far as I'm concerned, today is the end of all of the misogyny and the unfair prejudice that we've been experiencing. Enough is enough, my brother and sisters.
Daniel, nice to see you. Thanks very much for coming in. Well, that's Squawk Box. We've got to wrap it up here. Street Signs coming up next. Karen, myself, and I think Steve's coming back, isn't he, tomorrow? He will be back. So we'll be back tomorrow to do it all over again. Bye-bye.